Our market hit a record high yesterday as measured by the TSX Composite Index. But our guest says when you look at technical factors affecting the S&P 500, the picture may not be so bright. Let's get more from Jamie Murray, president of the Murray Wealth Group. Jamie, great to talk to you, and thanks very much indeed. Start off with your outlook for the TSX, though. Do you think it will tend to move higher for the balance of the year?
Yeah, we definitely think the TSX will continue its march higher. I think seasonally, it's a great time of year. The Santa Claus rally comes 80% of the time. 24 of the last 30 Decembers have been positive. So we still think it's going to be a great outlook, especially with some of the trade negotiations and economic news coming out of the government, like we saw yesterday with the pipeline and sort of the Unleash Alberta movement that we have coming forward. We think that's going to be good for the economy, good for the market. And yeah, it's just these seasonally, this is a good time of year. And when we've had a great 11 months, that generally bodes well for the 12th month.
Now, I don't think you're bearish on the S&P 500, but tell us, is it a more nuanced picture there for the American market?
Yeah, I mean, I don't think, we're definitely not bearish. And we've had a huge year as well in the United States. But certainly it has been a little bit more resistant, it seems like, to break out past the previous highs. And we're seeing some of the leaders of the market like NVIDIA, Microsoft, two stocks that we own, just kind of struggle right now to push higher. And so we might see a little bit of churn down south, and particularly as some profit taking occurs, some window dressing occurs, and some market rotation. So just that market being so concentrated and a couple of the really dominant, the two largest index constituents making up about 15%, NVIDIA and Microsoft, struggling to move higher right now. We might see some outperformance in Canada for the next few months.
Yeah, I'm just looking. I mean, Advanced Micro is down about 15% in the past month. Alphabet, of course, is rocking and rolling, up more than 20% since late October. But I mean, one criticism, of course, of the AI spending boom is that they're installing all this equipment, but tech stuff wears out. It should be depreciated pretty quickly. Now, people may say that's just an accounting item, but I guess there is a real risk that they're spending tens of billions of dollars on equipment that could be obsolete before too long.
Yeah, so I think there's a bit of missing nuance between leading edge and front of the line technology and the useful life of technology. Certainly, when NVIDIA puts out a new GPU and they're now on an annual cadence, the leading technology model companies are going to move to those brand new chips. You get more power, more performance out of them. But that doesn't mean that the old chips are still obsolete. There's still very high workloads running on those GPUs from even 2021. A great article I read was when Microsoft, who was the initial company that started to extend these useful lives on chips, which actually started before the GPU AI boom. It was in 2021, 2022. They were retiring chips that were 7, 8, 9 years old. And so that was, I think, the rationale to extend depreciation schedules from 4 years to 6 years. And just like a new car, it depreciates strongly as soon as you drive it off the lot. But just because it's a 2-year-old car and there's better models available doesn't mean that the 2-year-old car has no more value and it should be written off.
You have some ideas for us here. Doman Building Materials, DBM, they're huge in pressure-treated lumber. Why do you like this name, Jamie?
Yeah, and so going back to the top, we're saying maybe Canada's going to outperform. A few Canadian ideas that we think can do well, and starting with Doman. So we saw the forestry sector have a strong move up. Doman has been a leader in the forestry sector, but they're not taking the lumber price risk that the forestry companies that we traditionally hear about do. They're buying that lumber from those companies, treating it, and then it's also about the distribution and inventory management for large retailers. And so it's a relatively stable business in the forestry sector. It's more of a volume game and a price spread game. So when we're talking about midstream oil companies, at the top. Doman's more akin to those companies versus an oil company. So it's a great model. They've done a great job consolidating Canada and now the United States. They're a top 3, 4 player in North America. And that scale brings additional competitive advantages like better purchasing power, better logistics. And I think the free cash flow yield on this stock is about 14%. So you get a 6% dividend. There's still lots of cash left over after paying that dividend to grow the company and make further acquisitions.
Linamar, globally big in agricultural equipment. Apparently that market not doing very well, broadly speaking, but also, of course, autos.
Yeah, and so Linamar, we're seeing the stock, I think it's just actually below its all-time high, around $83, $84. It's hit that a couple of times over the last decade. We're seeing a bump up against that. And this is a stock that, if you look back over the really long term, it tends to have these big moves like 200-300% higher, and then it'll consolidate for almost a decade. And it's been a decade that Linamar has been trading between that $50 to $80 range. The multiples come way down. We're seeing the auto sector, not that the end market has improved, but Linamar's auto business is doing really well. Margins are moving higher. They're acquiring underperforming competitors. And that's going to drive earnings per share higher. And like you said, they do have an agriculture and industrial business. That business is depressed right now. It's going to take a year or two for that to recover. But we think when you start to look out to the end of 2026 and into 2027, you're going to have all three of its businesses moving the right direction. You can see earnings per share growth in those cyclical upswings of, call it 10, 15, 20% per year. And so, I think Linamar is just still at the start of a long-term move higher.
And then finally, Northwest Healthcare Properties, a real estate play, doctors' offices and stuff.
Yeah, so they own the medical office buildings. They own some hospitals as well. So it's a real estate play on medical properties. I mean, I've been on the show and we've written about it on our website. It's had a long history. It had a poor performance in 2021, 2022. That's the past. There's a new management team in. They're doing all the right things. They're selling off assets. The debt, which was an issue 2 years ago, is now under control. They're finding ways to optimize the business. The net asset value of this company is probably around $8 per share, and it's trading at $5.40. A very stable business. I think in Canada, the market loves the apartment REITs, and those you get a 3-4% dividend yield on. But in Canada, we're seeing pressure on home prices, pressure on rents, a huge amount of rental supply coming in. And so, if you're owning a Canadian apartment type company, I'd much rather own Northwest, where you get that economic, not sensitive to economic activity, a nice dividend that's growing, and a market that should have a really good next decade.
Jamie, thank you very much indeed.
Yeah, thanks for having me.
Jamie Murray, president of the Murray Wealth Group.